Today I would like to analyze JD.com. It's one of the biggest e-commerce companies in China. And today Walmart announced that they are selling the JD.com stake worth over $3.74 billion. The stock price reacted already. It's down over 10%. And when we look the 1-year chart, we can also see the company is down over 15%. So it's an interesting company to look more about. So we're gonna take a look at the financials and find out if this company is actually undervalued or is it still overpriced. So today, after the 10% drop, we still have a market cap of 313 billion Hong Kong dollar, which is around $36 billion. And this is not a small company anymore, but it still has enough room to grow in the future. We also have the dividend yield of 2.65%, which is very interesting to me as well, because I think it will be a growing dividend in the future. So now we can take a look at the financial foundation. The first thing we are looking for is revenue growth over the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2019, it was around 644 billion Hong Kong dollar. And now in 2023, it's around 1.2 trillion Hong Kong dollar. So we can see the very good growth over the last 5 years. And this is a check here. The next thing we are looking for is free cash flow growth over the last 5 years. So this is very important as well, because the free cash flow is used to pay the dividend or to finance the stock buybacks. So we want this to grow over the last 5 years. We can see here in 2019, it was around 19.12 billion Hong Kong dollar. And now in 2023, it's over 49 billion Hong Kong dollar. So we have a significant growth over the last 5 years, which is really great, and we like to see that. Now we're going to take a look at the free cash flow yield. We want this to be over 4%. It also can tell us about the valuation. So if it's under 4%, it could mean the company is overvalued. So we're going to take the free cash flow from 2023. So it's around 49 billion. And we're going to divide it with the market cap of 313 billion. Then we will get the free cash flow yield. So this is around 0.1565. So it means over 15% free cash flow yield, which is really incredible actually. This is very rare to see, and I think it's one of the things we can see in the Chinese stock market. So it's a check here, and this is actually really amazing to see. Now we're going to take a look at the balance sheet, and we want to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So it's a very important number, because if the company has too much debt and cannot pay it, it could go bankrupt in the worst case. So we don't like to see that. The first thing we are looking now is the short-term debt. We can see here it's around 14 billion. Then we're going to take the long-term debt as well. We can see it here, 61 billion. And then we're going to divide it with the free cash flow that we had, 49 billion. And then we will have the debt to free cash flow ratio. Okay, this is around 1.53. So this is again an amazing number. It means we can pay back the debt in a little bit over 1 year. So it's a check here. And we also can take a look at the cash on hand. So how much money does the company have in the bank? And we can see here it's over 217 billion Hong Kong dollar. So this is amazing as well, because they can pay the debt with the cash on hand already. And they can use this money to invest in the growing business, or to buy back shares, or to pay the dividend. So they have a really good balance sheet. The last thing we are looking for is shares outstanding decrease. Especially if a company is undervalued, we would like to see them buy back their own shares. So now we're going to take a look here at JD's shares outstanding, and we can see in 2024 they did buy back over 4% of their own shares. And they also announced this, that they're buying back $3 billion of their own shares. So this is a good check here as well, because we would like to see them buy back their own shares, because I think they look so undervalued. So they have to give their shareholders some return in form of the dividend or in form of their shares buyback. I would like to give my conclusion about this company. So let's start with the good things. They have incredible financials. They have a very high free cash flow yield, over 15%. They have a very good balance sheet with less debt and a good amount of cash on hand. They also have a growing business in the e-commerce. They look undervalued. They have stock buybacks, which I think is very important for Chinese companies because this can help the stock price to increase again. And they also have a dividend, which I really like about it. The negative things would be hard to understand the market position. So we don't really know how strong is the competition, how is their market position in China. And Chinese companies are often undervalued. So we also have the political risk, and that's why the Chinese companies are often undervalued compared to American companies or European companies. So we have to keep this in mind as well. But I think this company looks very interesting at the current price. So I hope you enjoyed this video, and please leave a like and subscribe to support this channel.